listen-only mode.
Hello and welcome everyone to today's webinar on Section 6055 and 6056 MEC and ALE Reporting to the IRS. Thank you for joining us today. Our webinar today is scheduled to run approximately 50 minutes, and we will have some time at the end for any questions. I'm joined by Stacy Barrow of Proskauer Rose, who will be leading us through today's topic. Stacy is an associate in the Labor and Employment Law Department and a member of the Employee Benefits, Executive Compensation, and ERISA Litigation Practice Center, as well as a member of Proskauer's Healthcare Reform Task Force. Today's webinar is being recorded, and we will post a copy of the recording as well as the slides being presented onto the Client Resource Center so that you can refer back to them after today's session. You may also access access the slides right now through the chat dialog box in your GoToMeeting platform. So we've included a link for those there. If you do have any questions during today's webinar, we ask that you enter them in the questions dialog box, and they will be presented to Stacy at the end of the session. At this time, I'll turn it over to Stacy to get us started for today. Stacy?
Thanks, Chris, and good afternoon, everyone. This is Stacy Barrow from Proskauer Rose in Boston. Today's topic for the Essential Monthly webinar is the IRS reporting forms, the new ACA reporting that is applicable to providers and other like insurance companies and self-insured plans, as well as applicable large employers, the entities that are subject to the pay-or-play mandate. So I'm going to start off this afternoon with a very brief update on recent developments. Really only have one or two updates to share with you, and then we'll jump into the bulk of today's session, which will be all about the reporting forms. So in terms of recent developments, not a ton of notable developments since the last time that we spoke. One interesting update, and we just sent out an alert on this over the last day or so to Essential members, and this is regarding the Health and Human Services 2016 Notice of Benefit and Payment Parameters. This was a rather lengthy regulation that provided a bunch of clarification on issues relevant to insurance companies and qualified plans that are available through the marketplaces, and it also had some guidance for employer-sponsored plans, including self-insured plans, with regard to minimum value and possibly out-of-pocket limits as well. This final regulation here had a clarification that actually didn't make its way into the regulation itself. It was buried within the preamble, and the clarification that was made by Health and Human Services was that the Affordable Care Act's out-of-pocket limits that started to apply to non-grandfathered plans in 2014 really have an individual embedded out-of-pocket limit within a family plan. And so an example here is that if you have, say you have an employee roles in family coverage, and the family plan has an annual out-of-pocket limit of $13,000. And during that 2016 plan year, the employee's spouse has $10,000 in out-of-pocket spending, and the employee has $3,000. In past years, in 2015, the plan would cap the spending once the combined spending from the family hit that $13,000 limit. With this new limitation, the cost-sharing payments that are attributable to the spouse have to be capped at the self-only limit, which is $6,850 for single coverage in 2016, and the remaining $3,150 of the $10,000 in expenses that the spouse has incurred, cost-sharing and out-of-pocket expenses, has to be covered at 100% by the plan. The 2016 limits are $6,850 for single coverage, $13,700 for family coverage, and these limits apply to covered in-network essential health benefits. And These limits are not specific to high deductible plans. They apply to all group health plans. High deductible and your regular non-consumer driven plans like HMOs and PPOs, POSs and such. The only thing that's really unclear at this time is exactly what types of plans this applies to. It's an HHS regulation, and typically when the regulators issue rules that are intended to apply to all group health plans, like including fully insured and self-insured, ERISA plans, they typically do it in triplicate. They'll issue IRS regulations and DOL regulations and HHS regulations, and they've done that with many of the rules under the Affordable Care Act. One example would be the preventive care requirements. Those all were released in triplicate. The 90-day waiting period rules, those are all released in triplicate. But here, we only have HHS regs, and so it's quite unclear as to whether the IRS could enforce this particular provision against a self-insured plan. So again, this will be effective in 2016. We have, a year or so to get further clarification on that from HHS, but it's something you should keep in the back of your head when you're doing planning in the next, in the coming months for 2016 renewals. One other update or issue to address that is somewhat relevant to today's session is with regard to individual tax returns for 2014. What we're seeing out there, some of our clients, their employees are coming to them and saying, I've taken my W-2 to my accountant to do my taxes, and my accountant says that you need to give me a 1095 form for us to complete our tax returns. And the bottom line for 2014 is that the B and the C series of the 1095 forms are not necessary this year. They're not required to prepare an individual's tax return. The only 1095 form that folks might get for 2014 is the 1095A, and that is used to reconcile premium tax credits by the folks who had marketplace coverage. So employers are not required to provide the forms this year for 2014 tax returns. But as we go through them, we talk about the effective dates, you'll see that they are effective 2015 with the first reporting due in the first quarter of 2016. Okay, so let's jump into the bulk of today's webinar, and that is covering the employer and provider reporting requirements. So in terms of kind of getting ready and gearing up for this, just be aware that the ACA does impose fairly complex reporting requirements in order for the government to track compliance with the individual mandate, the employer mandate, and to determine eligibility for premium tax credits. And so after today's session, you should be able to determine which of the reporting requirements apply to you as an employer based on your size and your plan type, whether you're insured or self-funded. And also, you'll need to sit down very likely with your benefit consultant who invited you today through the Essential Group and understand which of your internal systems house the information that's necessary for the reporting. Some employers might be able to get by with just using their payroll systems. Other employers may need to pull information from time and attendance as well. And the general principle here, and we're going to talk about this afternoon, is that you're going to basically need to be able to identify whether a particular employee was full-time or part-time in a given month. You'll also have to be able to report to whom you've made an offer of coverage, the premiums you charge for that coverage, and whether you as an employer are part of a larger tax-controlled group. That's also going to be part of the reporting, and we'll cover that in a second, actually on this slide. When determining if you're an employer that is subject to the pay or play mandate or the reporting rules, the determination is made on what is called a tax-controlled group basis. So if you are part of a larger tax-controlled group, Maybe you are a parent company and you own a number of subsidiaries, or you are the subsidiary of a parent company, or you have brother-sister controlled groups, affiliated service groups. You will aggregate all of your employees together to see if you're over that 50 full-time equivalent employee threshold. And the reason that you need to understand which entities are within your control group is, one, you have to understand that and be aware of that in order to determine if you're a large employer, and you also need to disclose that information on Form 1094-C. That's one of the forms that goes to the IRS. It's for applicable large employers, and as we'll see in a few minutes, there's one of the sections that will require you to disclose any related entities. One thing that is important to mention is although we are aggregating all of our employees together to see if we're a large employer, all of the employees within our tax-controlled group, the penalties for failure to comply with pay-or-play mandate and the reporting itself, once it comes time to actually do the reporting, it's all based on a per tax ID basis. Now, each entity with its own tax ID will have its own reporting obligations, even if it's part of a parent subsidiary group. The reporting will be completely separate for each EIN. There's no real overlap. The only thing you'll do is disclose other members of your controlled group on the form, and we'll take a look at that form in a second. So in terms of the high-level overview of these two reporting requirements, there are two new reporting requirements added by the Affordable Care Act to the Internal Revenue Code, and they apply to different types of entities. The Section 6055 reporting is for providers of health insurance coverage, and so this will include folks like the insurance carriers. It'll also include self-insured group health plans. They are considered to be providers of health insurance. It also includes multi-employer plans like the union plans and governmental plans. Those are the providers, and they are subject to Section 6055. So if you're not an insurance company and you're not a self-insured plan, then you do not have an obligation under Section 6055. If you are fully insured, your carrier will take care of that obligation for you. And we're still going to cover it, though, so you understand what is required. Section 6056 is an employer requirement. This applies if you are what the government calls an ALE, an applicable large employer, and you're an ALE if you had at least 50 or more full-time equivalent employees on average in the prior calendar year. That's what triggers ALE status for the current year. So Section 6056, again, is an employer requirement. You're reporting full-time status. You're also reporting on any coverage that you offer, but this will apply to you as an employer even if you don't offer a group health plan. If you have 50 employees, you have the Section 6056 requirement. If you're self-insured, not only do you have to report on your full-time employees, but if you're self-insured, again, you have that Section 6055 requirement, so you'll be reporting on full-time employees regardless of enrollment status, and you'll also be reporting on any other employees who happen to be enrolled in the plan, whether they're full-time or part-time or COBRA participants. You have that obligation as a provider of a self-insured plan. So these rules were originally intended to be effective in 2014. They were delayed until this year. The first mandatory reporting will be in the first quarter of 2016, representing the 2015 calendar year. So this is a big issue this year. It's something that employers should be aware of and paying attention to. It's very granular and complex reporting. As you're going to see in a few minutes when we go through the forms, There are all these different codes that can apply, and it's going to be a time-consuming process even for smaller employers that maybe only have 50 full-time equivalents. So mention that these are complex requirements. One important thing to note is that if you're in that 50 to 99 full-time equivalent range, and so you're exempt from the pay-or-play mandate in 2015, you don't have to comply until 2016, you still have the reporting requirements that you'll need to complete for the 2015 calendar year. So even though you don't have to offer affordable minimum value coverage until 2016, if you're in that small group, the 50 to 99 range, you still have the full reporting requirements for 2015. Okay, so now let's dig into the forms and the two code sections. So the first one is code section 6055, and again, this is for the providers of health insurance. So the insurance companies, self-insured plans, pardon me, multi-employer plans, and governmental plans. And the government is going to use this information to track compliance with the individual mandate. Oops. Okay. So the forms that are associated with Section 6055 when the carrier is doing the reporting are the B series forms, B as in boy. So if you're a small employer, you have fewer than 50 FTEs, and you're offering fully insured coverage, you have no filing requirement. The carrier is going to take care of any filing requirement that you may have. Yes?
Sorry to interrupt. We're not seeing a picture in your slides.
Oh, sorry. Let me make sure I'm sharing here. Are you back? It should be slide 11.
Yeah, we see it, so you're good.
Okay. Now it's expanded?
It is, yes.
Okay. Sorry about that, folks. I was trying to check one of the questions that came in to see if I could answer it on the fly, but I think I'm going to leave them to the end so I don't goof up our presentation here. Okay. So when you're fully insured, the carrier is going to send out the B series forms. They're going to send out the 1095B to every covered participant. One copy goes to the employee, one copy goes to the IRS, and then the 1094B is essentially like a cover page to all of the 1095Bs that are sent to the IRS. If you are a small employer and you're under 50 FTEs and you're self-insured, which is very rare, then as a provider, you will have the B series forms to file for your covered participants. But again, you're only doing this if you are under 50 FTEs and you're self-insured. If you're a large employer and you're self-insured, then you're going to be filing using the C series form. So from an employer standpoint, basically almost 100% of the time, you're going to be using the C series forms unless you are very small and self-insured. So this is what the 1094B looks like. This is the cover sheet essentially to all of the 1095Bs, and this is filled out by the insurance company. So fairly straightforward. The name of the carrier, contact information, total number of 1095Bs that are submitted, and then this is a copy of the 1095B itself. Again, the B series forms we sent out by the insurance companies and by multi-employer plans. And this has basic information. Part 1 is the name of the insured. Part 2 is whether it's employer-sponsored coverage. Part 3 is the name of the carrier. And Part 4 are all the covered individuals, meaning the employee and his covered family members, with a disclosure as to which months they had coverage. 1095B is fairly straightforward form. Now we're moving into the C series forms. which are going to be really more applicable to most of the folks on the call today. The C-Series forms are required as part of the applicable large employer reporting, and these are used by the government to track pay-or-play compliance and to determine individuals' eligibility for the premium tax credits. So just like the B-Series forms, there's one form, the 1094-C, that gets transmitted to the IRS, and then there are other forms, the 1095-Cs, that get transmitted to the employees, and one copy gets sent to the IRS. These are due to employees basically at the same time the W-2s are due. That is by January 31st of the year following the reporting year. So January 31st of 2016, all of the 1095-Cs will be due, representing the 2015 calendar year. You can provide these forms electronically to participants or employees as long as they have affirmatively consented. This is different than the ERISA consent, which allows you to basically assume employees automatically consent if they use email as part of their job. This is a little different. They want you to get affirmative consent from employees before delivering these electronically. For fully insured plans, you only have to complete the top half of the 1095-C. That's parts 1 and 2. When you're self-insured, because you have the reporting requirement for a provider, you have to complete the entire form, parts 1, 2, and 3, and we'll take a look at what they look like in a second. But the general rule here is that you have full reporting on a monthly basis for all of your full-time employees. And we'll have to disclose things like the monthly premium for single coverage, to whom it was offered, was it just employee only, or maybe it include an offer for spouses and dependents. We also have to disclose whether coverage provides minimum value, and then indicator codes will be used to report a bunch of other information that we'll look at in a few minutes. One of the other complicating factors to all this is that if you are, a decently large employer, if you have to pull together 250 or more of these 1095-Cs each year, then you must file them electronically with the IRS. And so this process or procedure is still being worked on by the IRS. They have not released exactly how you're supposed to get all your information into these electronic forms. I'm sure there are some vendors out there that will help you for a price, but this is something else to be aware of. If you are a larger employer, you'll need to be able to provide these forms electronically to the IRS. So let's take a little closer look at the Form 1094-C. I'm going to describe some of the data elements, and then we'll take a look at the form itself. So again, this is the transmittal to the IRS. Think of this essentially as like the cover page to a fax, where the body of the fax are all of the 1095-Cs that you have to send to the IRS. And so this will, the 1094-C basically just provides a summary of information to the IRS regarding what type of transition relief you're claiming, whether you generally are making an offer of coverage each month, whether you're part of a tax-controlled group, the number of 1095s that you are producing, and then your full-time and total employee counts by month. So a lot of info. Let's take a look at the form. Part 1, very standard employer information. There should not be information you don't already have. Line 18 asks for the total number of 1095-C forms submitted with this transmittal. And so I mentioned that even when you're part of a larger tax-controlled group, if you have your own tax ID number as an employer, you will have your own 1094-C. You may have more than one 1094-C as an employer, but I think it's going to kind of be unlikely. For the vast majority of employers, whether or not you're part of a larger tax-controlled group, you will have one, and and only one 1094C, and that will be your authoritative transmittal. So let's talk about line 19 for a minute. And the question here is this form the authoritative transmittal for this ALE member? So I mentioned that the penalties under pay or play in the reporting all apply on a per tax ID basis. So if you're a member of a larger tax control group, you're going to disclose that on line 21, but each company with its own tax ID will have its own authoritative transmittal, its own authoritative form 1094C. And for many companies, the only 1094C that they'll have will be the authoritative transmittal. So as an example, companies A, B, C, and D are all commonly owned. Say they're all part of a larger tax control group. A, B, C, and D are all related. They all have their own tax ID numbers, and so each of companies A, B, C, and D will have their own authoritative transmittal because Company A is an ALE member, Company B is an ALE member, as is C and D. Now, when might you have more than one 1094C? If you have divisions within one ALE member that roll up to the tax ID number of that ALE member, then perhaps you might have 1094Cs for each division. But again, I think that's pretty unlikely. It's really only going to occur if they're running their own payroll system, or maybe you do your reporting separately for union employees. But again, I think vast majority of employers are going to have one 1094C, and that will be the authoritative 1094C. In any event, one employer with one tax ID will never have more than one authoritative transmittal. Okay, let's move on from that line. Number 20 is just the total number of 1095Cs filed by that ALE member. 21 is disclosing your controlled group status. And then 22 are the various types of transition relief that might apply. You have the qualifying offer method. There's a transition relief for the qualifying offer method for 2015. There's Section 4980 transition relief, which might be non-calendar year plans, things like that, dependent relief, and then the 98% offer method, which is another type of simplified reporting, which we'll get to in a minute. This is the second page of Form 1094C, and here you have 5 columns, A, B, C, D, and E, in which you will disclose if you've made an offer of minimum essential coverage to at least 95% of employees per month. And if you did it for all 12 months, you check line 23. If you only made the offer for certain other months, you'll check the applicable lines from 24 to 35. Now, for 2015, there is transition relief that brings the 95% number down to 70%. So you can answer yes in column A here if you've made an offer of minimum essential coverage to at least 70% of your full-time employees in any given month. You just check the months you've made the offer, check line 23 if it's for a full year, and that's your that's how you disclose. Columns B and C are disclosing the full-time employee count and then the total employee count. So you're going to have to be able to distinguish between which of your employees are full-time and not full-time on a monthly basis. There is a simplified method of reporting. If you offer coverage to full-time and part-time employees, you may not have to disclose your full-time employee count here in column B, and I'll talk about that in a few minutes. Column C is the total employee count. Column D is whether you're part of a larger tax control group, and then column E is whether you qualify for any transition relief as a small employer, as a large employer. There are different codes you're going to use for that column. Part 4 is where you list out all of the other ALE members that are part of your tax control group and their EINs. So those were the nuts and bolts of the Form 1094C. I'm going to focus now on the 1095C, and this is the big one. This is the form that all full-time employees will get in 2016, and any other employees that are enrolled in coverage under a self-insured plan. So what information is required to complete the 1095C? You need to know which employees are full-time in a given month, identifying information like their name and address, information about the type of health coverage offered, the employee's share of the premium, months in which the employee was enrolled, any months in which the employer met an affordability safe harbor, and then lastly, at the bottom here, if you are self-insured, you have to capture information regarding any covered individuals. So this is what the 1095C looks like. Part 1 is just employer and employee information. Part 2 is really your operative piece of this form here. There are indicator codes that we're going to touch on in the next few slides that will give you the information necessary to complete lines 14 and 16. And then depending on if you've made an offer of coverage in line 14, you'll also disclose the cost of that coverage in line 15. So line 14 is disclosing what offer of coverage you've made. Line 15 is the cost of that coverage. And then line 16 is basically telling the IRS what's the best reason why the employer should not be penalized with regard to this employee. Is it because the employee wasn't full-time? Is it because he enrolled in coverage? Did he decline coverage but it was affordable? Was he covered under a multi-employer plan exception? Was there transition relief? So whatever code fits best, and we'll talk about the codes in a minute, you're going to use that code in line 16. If you're fully insured, stop here after parts 1 and 2. If you are self-insured, you will have to complete part 3 for any covered employee and covered family members. And you can see here in column B, it asks for a Social Security number. Column C asks for a date of birth if the social is not available. But unfortunately, you do have to make a good faith attempt at obtaining Social Security numbers of covered dependents. Again, this doesn't matter if you're fully insured. The carrier takes care of it. But if you're self-insured, you have the obligation to complete Part 3, and so you need to make a good faith effort to collect socials of the dependents. So the preamble to the reporting regulations explains that an employer will be considered to have made a good faith attempt at collecting socials if it tries to collect it at the time of initial enrollment of the employee and dependents. If it doesn't work at the time of initial enrollment, request it once more before the end of the plan year, or if enrollment is in December, the end of the following plan year. And then one more time, which will be the third time, at the end of the following plan year. And if you're rebuffed at each of those could be attempts, then you can use the date of birth rather than the Social Security number, and you can use the date of birth in the meantime if reporting is due in the interim. But you do need to make a good faith effort at collecting those socials, so just be aware of that if you're self-insured. So here are the indicator codes that I mentioned for line 14, and these are the codes that will disclose what type of offer of coverage was made, if any. So 1A is the qualifying offer. That's a loaded term. We'll describe that or define that later. And then 1B through 1E is when you're providing coverage, and you just pick which derivation of that applies. So is it employee only? Then it's 1B. If it's employee plus dependent children coverage without spouses, it's 1C. If it's coverage to employee and the spouse, not children, it's 1D, and 1E is the one that I think most folks will use, and that is minimum essential coverage, providing minimum value that is offered to the employee and his dependents and his spouse. 1F might be for like a skinny plan where you're offering minimum essential coverage, but it doesn't provide minimum value. 1G, kind of an odd indicator code here. This is used only to report coverage by an employee who is not a full-time employee for any month of the year and who enrolled in self-insured coverage. So this could be someone like a COBRA participant in the year after termination or a retiree in the year after retirement who are enrolled in self-insured coverage. 1H is no offer of coverage, maybe because the employee wasn't employed or he was part-time. And 1I is the qualifying offer transition relief. You're basically allowed to use that code if an employee received a qualifying offer. If you have any qualifying offers made to any employees, you can use this transition relief for 2015. So I mentioned B, C, D, and E are the offers of minimum value coverage, and so the government is interested in what the coverage costs only if it's minimum essential coverage and provides minimum value. So if you use B, C, D, or E in line 14, then you have to enter the amount of the coverage in line 15. And again, this will be the lowest cost minimum value coverage that's the employee-only cost. So this might be different than the amount the employee actually pays if he buys up or if he enrolls family members. Obviously, his premiums will be greater, and we're just disclosing in line 15 the lowest cost employee-only premium for a plan that provides minimum value. Okay, line 16, again, is the line that you use to tell the IRS why you should not be penalized as an employer for any given month. And the instructions recognize that in certain situations, you may have more than one indicator code that could apply to the same employee in the same month. For example, you might have someone enrolled in the plan during a month in which he or she is not a full-time employee. And so there are codes for each of those situations. However, you can only use one code for a particular month. The IRS has established trumping rules essentially for these codes, and they say for any month that you have an employee that actually enrolled in coverage, you must use code 2C in line 16 instead of any other indicator code that could also apply. And then if the employee did not enroll in health coverage, the instructions further specify the ordering rules for which codes to use. So let's take a look at the codes, and just to jump to the next slide for a second, there are 2 slides worth of codes here. So first one is 2A, employee was not employed during the month. 2B is he is not a full-time employee and not enrolled, and you'd use this if an employee terminated during the month. 2C is for whenever an employee enrolls in coverage, and this is the code you use regardless of whether any other indicator code might apply in line 16. If the employee enrolls, you're always using code 2C. Code 2D is to notify the IRS that an employee is in a limited non-assessment period, and that includes such things as the initial measurement period or a waiting period. 2E is used to denote the employee qualifies for multi-employer plan transition relief or interim relief. I'll talk about that in a minute. 2F, G, and H are the safe harbor, the affordability safe harbors, W-2, FPL, and rate of pay. And 2I is used to denote that non-calendar year transition relief applies to that employee. Okay. So those are the forms. I want to focus now on some of the clarifications that were made in between the draft forms and the final forms, or some clarifications that were made as part of the final forms. This one is particularly helpful, and this clarification is that if you have an employee working for you and he's either not an employee or is in a limited non-assessment period for the entire year, then he does not get a Form 1095-C. So for example, if you hire an employee in July, January through June, he was not an employee, and then he's variable hour, so July through December, and really through next June, he's going to be in an initial measurement period. He's not required to be treated as full-time during any month of the year, and so he does not get a 1095-C, assuming he's not enrolled in self-insured coverage. Obviously, he'll still count as an employee in the total employee count on Form 1094-C, but you won't have to give that individual his own 1095-C because he was never required to be treated as a full-time employee. This is a clarification from the final, from the draft forms. Another good clarification is regarding spousal. Actually, I'm sorry, this is a different one. Another good clarification is that when you offer coverage to folks who are not employees, and these could be non-employee directors, could be retirees in the year after retirement, or employees on COBRA in the year after termination, it was unclear which series of forms you would use to do the reporting. It was anticipated that you would have to do the B forms for non-employees, but the final instructions have clarified that the C series forms may be used if the employer desires. So again, this is really only applicable to those with self-insured plans, but just be aware that if you're self-insured and you're a large employer, you can use the C series forms even for folks who are not employees but who are enrolled in your plan. Another clarification is that when you have reasonable conditions on the offer of spousal coverage, you can still treat it as being an offer of spousal coverage. So for example, say you offer coverage to employees, spouses, and dependents, but the spouse can only take the plan if she doesn't have access to her own health coverage through her employer. Rather than figuring out, okay, well, which spouses have access, which spouses don't, you can report the offer of coverage as being an offer of spousal coverage, even if the spouse can't enroll because she has coverage through her own employer's plan. So this eases the reporting burden on employers. Okay. So now we get to the simplified reporting. And I'm going to try to keep it high level because a lot of these simplified, there's only 2 simplified methods, but they're very limited in application. The IRS, when the draft forms were released, they were criticized by some interested parties, and complaints were that, well, look, a lot of employers out there, they offer good coverage. They offer, affordable minimum value coverage to their full-time employees. None of them are eligible for a subsidy. Isn't there some simplified way that we can report without all of this, nonsense? And the IRS's response was, well, okay, we'll give you 2 simplified methods, one of which is the qualifying offer. So here, you basically have to have made a highly affordable offer of coverage to the employee that also includes an offer of coverage to the spouse and the children. So here, you have to offer family coverage, employee, spouse, and children, and the cost to the employee of single coverage must be affordable under the federal poverty level safe harbor, which means that the employee's cost can only be about $1,100 per year for single coverage. And so if you've made that affordable offer to the employee and it includes an offer of coverage to the spouse and dependents, then you've made a qualifying offer, and that will simplify your reporting a little bit. If you do make a qualifying offer rather than doing the monthly reporting, if you've made the offer for the entire year, then you only need to report name, address, tax ID of employees who received that qualifying offer. You use that code 1A on line 14 to no qualifying offer. But if you didn't make it for all 12 months, say you had on calendar plan year transition relief, or you made a qualifying offer to a new hire but only for a portion of the year, then you have the full reporting for any month in which you didn't make a qualifying offer. Now, if you've made an offer, a qualifying offer to an employee for the entire calendar year, you can provide them with an alternative statement rather than a Form 1095-C. But let's take a look at really how useful this is. So first thing to note is that if you're self-insured, this does not apply. You do not have the alternative statement available to you. You have the full reporting. So if you're self-insured, forget about the alternative statement. If you're fully insured and you've made a qualifying offer for the entire calendar year, you can give employees an alternative statement instead of giving them the Form 1095-C. Now, how useful is this? I don't know if it's really that useful, because you still have to complete and provide 1095-C to the IRS. So on one hand, you have the exact form you have to give to the employee because you have to give it to the IRS. You could not give that to the employee and then develop a separate communication for him, but why would you do that? Now, I mentioned you can report that you've made a qualifying offer to employees in certain months, even if you didn't get one for the entire year, but you can't use the alternative statement unless the qualifying offer was made for the entire calendar year. So really, limited usefulness here. This is the content required for the alternative statement: employer name, address, and tax ID number, contact info, statement that they've received the qualifying offer and thus are not eligible for a premium tax credit, and then directing them to see publication 974 for more information. There is some transition relief for 2015. If you've made a qualifying offer to at least 95% of your full-time employees for one or more months of the year, you can use the alternative statement for all employees, even those that didn't get the qualifying offer for the entire year. There's the content information, but still, you still need to provide the 1095-C to the IRS. So, this does have kind of limited application here, at least to me. The second simplified method is known as the 98% method. This one might even be less useful than the one we just talked about. And this allows you to do your reporting without identifying whether an employee is full-time or part-time, as long as you've made an offer of affordable minimum value coverage to at least 98% of employees and their dependents that are included on your report. So when is this going to be useful? It's really only useful when you have a self-insured plan that offers coverage to full-time and part-time employees, and they make it affordable to part-time employees, and so they don't want to have to identify whether an employee is full-time or part-time for purposes of doing the reporting. And so here, if you qualify under this method, then you can do your reporting without having to complete your full-time employee count in column B of Form 1094-C. Fairly limited application here, but there it is. Last couple of points, and then we'll open it up to questions. There are special rules for multi-employer plans. These are not MIWAs, not multiple employer welfare arrangements, but multi-employer plans, which are the union plans, the ones that are sponsored by trustees of the union. It's contributed to by multiple employers pursuant to a collective bargaining agreement, and these types of plans have a little different aspect to them in terms of reporting. In terms of the liability for the reporting and for the pay or claim mandates, the employer reporting is still on the company. So if you have union employees, you still have a Section 6056 obligation for them to the extent they work full-time. The multi-employer plan has the Section 6055 obligation. So for your union employees, you'll be completing a 1095-C to the extent they work full-time, and the union will be completing a 1095-B to the extent they're enrolled in the union plan. As an employer, for your union employees, you can be credited with having made an offer of coverage to your union employees as long as you're required by the terms of the CBA, the collective bargaining agreement, to contribute for that employee, and the union plan will offer coverage to employees who satisfy its eligibility conditions, and the coverage is affordable in minimum value, and it offers coverage to those individuals' dependents. So if all of those things hit, then the employer can be treated as having made an offer of coverage to its union employees, even though they're covered under the union plan. And again, you still have the Section 6056 reporting requirements for your union employees, so they will get a 1095-C from the company and a 1095-B from the union. Okay, the most important slide of the day today, and that is regarding penalty relief. And the bottom line here is that for the first year or so, as long as you make a good faith effort to comply with these reporting requirements and you timely file your reports, you will not be dinged with regard to accuracy-related penalties. You still will need to show reasonable cause if you fail to meet the timely reporting requirements, but if you mess up one of your indicator codes, it shouldn't result in accuracy-related penalties as long as you've made a good faith effort to comply. That ends my prepared slides for today. I think we have about 5 or 10 minutes. I'm happy to open it up to questions.
All right, thank you very much, Stacy. We do have a bunch of questions, so we'll try to get through all these here in the next few minutes. Just to answer a couple of them right off the bat, we will have the recording as well as the slides posted to the Client Resource Center. You can also access the slides through the chat dialogue while we're live here. So, first question: can you explain affiliated service groups in relation to control groups?
Yeah, they're entities that perform certain managerial services for their client employers. Like, an example of an affiliated service group might be a management company that performs management services for a number of hotel groups, something like that. That's one example. There are ways that unrelated companies can still be part of the same controlled group due to the level of oversight. And again, these are incredibly complex rules. If you're out there and you feel that you might be an affiliated service group, you should talk directly to your own counsel, and we're happy to help with these kinds of analyses.
Okay, the next question asks, when figuring the size of our company, is it based on the fact that we have a different EIN than our parent company, or do we still have to be at it with our parent and sisters? What exactly do you mean by controlled?
So you do need to aggregate all of the employees among your related entities to see if you're a large employer. So like, companies A, B, C, and D, if they're all related, you're adding up all of the company employees of companies A, B, C, and D to see if you're a large employer. Once you've determined that you're a large employer, you go back to treating A, B, and C, and D separately for reporting purposes and for pay-or-play purposes. And again, whether you're part of a controlled group is a tax analysis. It requires looking at the incidence of ownership among the entities. It is something that you should do only with the assistance of qualified ERISA counsel. And again, we're happy to help with those analyses.
Okay, next question. I'm part of an organization who had 145 employees as of January 1st, 2015. We lost a large contract, and by February 15th, we were down to only 20 employees, and we'll be down to 10 employees by May 1st. Is the calculation of 50 full-time equivalents the average over 12 months in 2015, or is it by month?
It's the average over the prior calendar year. So in this example, they said they had 145 employees on 1/1. Let's assume that was their average over 2014. So the averaged over 100 in 2014. That means they're subject to the pay-or-play mandate in 2015, and they're subject to the reporting requirements in 2015. But there is some relief for this company, at least with regard to penalties. You still have to report full-time employees, but when you've shrunk down to 20 employees or 10 employees, you know that you can reduce from the $2,000 pay-or-play penalty the first 80 full-time employees if you had over 100 FTEs in the prior year. So based on your description, the only month you could possibly have any exposure for is January, because that's, you have over 80 full-time employees in January. Once you get to February, say you have 20 full-time employees and one of them goes and gets a subsidy because you didn't offer coverage to any of them, then your penalty is still zero because you get to reduce the first 80. So, while it doesn't relieve you from the reporting requirements, it does relieve you basically from the penalties. Hopefully that helped.
Okay. The last I heard, the IRS had not finalized the formatting for submitting 1095 forms electronically. Do you have any idea when the required formats might be published?
Yeah, that's right. I mean, they haven't released it yet. I would think it would have to be in the next couple of months. I mean, there's going to be a lot of programming for payroll vendors and other vendors to do. So I can't see it going much more than another few months before it's released.
Can you explain aggregated ALEs? Does this mean a control group? Is that similar to the question we just had recently?
Yeah.
Okay.
An aggregated ALE group is just a controlled group with corporations.
Okay. Next question. We allow our retirees to stay on the plan post-employment until they turn 65. Will I need to complete a 1095C form for them also?
Well, if you're self-insured, yes, because they're covered under a self-insured plan. If you're fully insured, then the year after they terminate, they won't be full-time at all in that year. And if they're enrolled in a fully insured plan, the carrier will do the reporting. So, once they leave, and the year after they leave, if you're fully insured, then you don't have to do a 1095C. If you're self-insured, you will be giving a 1095C to your retirees until Medicare becomes primary.
Okay. If I'm a large employer and fully insured, will the insurance carrier file to the IRS the B series forms or participants, and I, the employer, file the C series for participants and non-participants? Therefore, both B and C series forms are filed.
Yes.
Okay.
Yeah.
Next question, for the lowest cost monthly premium on the 1095C, line 15, what does the company use if hourly employees' coverage is no cost to them and the salaried employees' lowest cost is $80 per month?
So that line is on a per employee basis. So if there are employees who have a $0 contribution, then you put in 0 for those employees. If there are employees that have an $80 contribution, you put in 80 for them.
Okay. Looks like we're up against the hour, but we do have a couple additional questions. We could follow up after. Stacy, I'm not sure. Would you prefer to follow up after? Or?
I have a minute if you want to answer a couple more. It's fine.
Okay. On 1094, regarding the 98% offer method, how does an employer certify that they've offered affordable coverage for all calendar months? Also, are there any reporting advantages, for example, less forms for those employers who offer coverage to 98% or more of its employees?
No, there's certainly not fewer forms to fill out. The 98% method, it doesn't really, you'll be filling out 1094 regardless. The only thing the 98% method lets you do is to avoid having to complete the column with the full-time employees. That's really all the 98% method gets you. So you'll still do all the regular reporting. It's just that one column in 1094C that you don't have to complete.
Okay. Next question, what if employee has coverage through spouse? Doesn't seem there's a code for this.
Right. You don't have to track if employees are enrolled in spousal coverage. There's no reporting for that. You would just make your line 14 entry that you offered coverage. Line 15 would have the price, and then line 16 would have any safe harbor that might apply, like maybe W-2 safe harbor or federal poverty level safe harbor, rate of pay safe harbor, or if none applies, then you leave it blank.
Okay. I assume 1099 employees won't have to be sent a 1095 since they are not considered full-time employees. She puts, unless the group actually offers coverage to their contract employees.
Yeah, that's right. So if they're accurately classified as 1099 independent contractors, then they're not employees, and you don't have to report on them unless they're enrolled in a self-insured plan.
Okay. Which code is used on a 1095? Which code is used on a 1094C line 16 for employers that qualify for 50 to 99 transitional relief when no coverage is offered? Is that line then left blank?
What code is used on 1094C line 16? That is the contact telephone number. Column E in Part 3 is used to denote the 50 to 99 relief or the 100-plus relief.
The person said 1095C, sorry.
And so, okay, so 1095C line 15, and the question was?
Yeah, they put line 16 for employers that qualify for 50 to 99 transitional relief when no coverage is offered. Is that line left blank?
It'll be 2I, most likely, the non-calendar year transition relief.
Okay. All right. I have a 12/1/2015 renewal, and I am a large employer. I do not offer coverage currently. Do I qualify for the transition relief if I don't offer coverage currently?
No, you're going to be subject to penalties as a 1/1. Well, how do you have a 12/1 renewal without offering coverage currently? That I think is kind of a non sequitur. But if you don't offer coverage, then you're a large employer. You're subject to the mandate on a 1/1/2015. If you are between 50 to 99 FTEs and you don't offer coverage, then you can have until 1/1/16 if you qualify for transition relief.
Okay. In Section 1095C, line 16, this might be the same question. What code would be used when an offer to coverage is made to a full-time employee but the employee does not enroll?
Any code that might apply. So usually it would be, it wouldn't be that he enrolled in coverage. It wouldn't be that he's in a non-assessment period. So it's probably going to be 2F, G, or H, one of the safe harbor codes, or maybe the multi-employer plan relief if he's a union employee. But if none of those codes apply, then you would just leave it blank. And there shouldn't be a penalty if the employee is enrolled in a spouse's plan or if he declines affordable coverage.
Okay. Who must do the 6055 reporting if you are an employer belonging to MEWA?
That applies at the plan level. It should be the sponsor of the MEWA. The plan essentially would do the 6055 reporting.
Okay, and our final question, will I have to pay the $3,000 penalty if an employee that I don't offer coverage to gets a subsidy in the marketplace?
Yes.
Okay.
If he's full-time.
Great. All right. Well, thank you very much, everyone, for joining us. Thank you also, Stacy, for hanging on a couple extra minutes. Just as a reminder, we will have the recorded link as well as the slide deck posted to the Client Resource Center shortly after we depart here today. So thank you, everyone, and we hope to see you on our future webinars. Have a great day.
Thanks, Chris. Have a great day, everyone.